Hey everyone, and welcome back to this week's episode of the Vancouver Life Real Estate Podcast. This week we're talking about the Silicon Valley Bank failure, one of the most stunning bank failures in U.S. history. In fact, it was the second largest bank to ever go under. We're also going to look at inflation rate. In the States, it's dropped from 6.4% down to 6%. We're going to look at what these two impacts could have on our own interest rates here up in Canada and how they're going to affect the housing market. And lastly, we'll also touch on sort of a half-month review of what's taken place across the housing market, both nationally speaking and here in the GVRD. But before we get into that, guys, we've had a number of our own buyers and sellers on the sidelines here over the last few months, likely trying to wait for a better environment to buy or sell in. And in the wake of some of this news with Silicon Valley Bank, seeing bond rates actually tumble in an unprecedented way, the housing sector is already reacting to some of this news. And when we thought things were going to shift a bit more incrementally, they're now starting to shift a bit more suddenly. So if you're thinking about making a move here this year, I would highly recommend that you come out, have a discussion about your own particular place, and let's see if it makes sense right now or if it's worth waiting. So anyways, having said that, let's get into Silicon Valley Bank, because last Wednesday was a pretty significant day. The bank came out and publicly announced, which is also very strange, that they were trying to raise $2.25 billion and a $21 billion asset sale to get through the tough time this bank has found itself in after Feds have been raising rates at unprecedented rates. By Thursday afternoon, that didn't work, and it scared the general public so much so that there was a $42 billion bank run on deposits. This crippled the 15th largest bank in U.S. history, and by the end of the day, the bank was negative $958 million, and the stock had crashed 60%. This sent shockwaves through the U.S. and most of Canada and around the world. It had feelings of the 2008 financial crisis, as people were not sure what levels of exposure other banks had to this crisis. What was one of the biggest impacts that we saw? Well, the 5-year Canadian bond yield dropped significantly. It fell really hard. It actually fell harder than we've seen over the pandemic, over the global financial crisis. It fell to its sharpest level in 27 years. In 3 days, it went from basically 3.6% down to about 2.9%. Incredible for something that's supposed to be quite stable. What does that mean? Because 5-year fixed mortgage rates typically follow the 5-year Canadian government bonds. One typically leads where the other's going. And before this had actually happened, if you had asked me last week or early last week, I would have said that we were looking at pricing in one rate hike by the summer. After the Silicon Valley Bank fiasco and then this massive bond yield or the 5-year Canadian bonds that have dropped, we're now looking at 2 rate cuts, possibly one even as early as April coming up here, and a second one maybe even as early as this summer. And so, this kind of begs a bit of a discussion here too, Dan, because there's a bit of a moral of the story here that seems to be emerging. And I feel like we're almost entering an age of like institutional negligence. All right, it's like I'm feeling this need for the re-emergence of personal responsibility. Because, there seems to be very little consequence for the people who actually are in charge of these banks. When you look at this, for example, the CEO of SVB, he sold $3.5 million of his own shares 1 week before this whole thing happened. What a coincidence. And then on top of that, if you look back over the last 2 years, and this just came out yesterday, the executives inside that bank had sold their stocks internally to the tune of $84 million. So you can see here, I don't know who we trust when it comes to this. But as we've always said, keeping the majority of your savings in assets that you own or that you can control, that can produce arguably boring levels of cash flow that will consistently and predictably provide you with income, and keep your assets safe and in your control. Clearly, for me, Dan, this is a scary time when I look at what institutions are actually doing with the deposits that they get.
Absolutely. And you're right. White collar crime still seems to essentially get maybe a slap on the wrist. I saw something come across the CNN ticker the other day that basically said Biden ensures that essentially the people in control, the owners of that bank, will be fired. That was the headline.
Great. Yeah.
Okay. That's pretty extreme. Obviously not. But let's expand this a bit further, because there's a couple other things that I really took from this. And obviously I'm no banking expert, but we pay attention to this as close as we can. And it obviously affects our housing. So we want to talk about it. The first thing that happened right after this bank knew that it was failing is that Biden got in front of the general public and said, nobody worry, we've got them covered. Your money is safe. Now, understandably, he did this because he did not want to set off contagion where people would just run on all the other banks and it would set off this domino effect, triggering run on banks that would cause them to potentially collapse as well. So he had to calm the nerves, protect the bank, protect those assets that were in there, and hey, write another blank check, essentially saying, hey, no problem, here we go. We're still in a fiscal fantasy land. Let's just bail these guys out because that's the right thing to do, at least in the short term. Okay, we're seeing essentially, again, the can being kicked down the road once again. We remember the global financial crisis. Government just came in, bailed out the big banks. Everything was fine. And it wasn't fine, but it was a lot less worse than it could have been. It was the right thing to do. There doesn't look to have been contagion, at least as of yet, right? We could see another bank collapse tomorrow, today even. But for now, things are essentially, they're okay, I guess is a nice way of putting it. Now, let's also follow up and see what happened a couple days later. Credit Suisse, they lost their banker because the Saudi National Bank, who backs or used to back the Credit Suisse bank, said, look, we think that maybe that you're in trouble as well, and we're not backing you anymore. That sent their shares tumbling to an all-time low, around $2 they were trading at. But the next day, the Swiss Central Bank came out and did the same thing, said, hey, no worries, here's 50 billion francs. That's the equivalent of $74 billion Canadian.
Wow.
You're okay. Everybody who has money with you is okay as well. Again, it's just a bailout for everybody in one sense here. And if we kind of open this up a little bit further too and see how many banks have actually failed that maybe haven't been bailed out. And again, this is simply because they don't have the type of assets under management as these big guys do. Apparently, and I have not looked into this to see if it's true, but it keeps coming up as if it is by Google. So anyway, between 2001 and 2023, so we're talking 22 years, the US of A has endured 562 bank failures, according to the FDIC. That includes the most recent Silicon Valley Bank. That means in the last 22 years, a U.S. bank fails every 2 weeks on average.
Holy cow.
Now, if we go back to 1970 with that number, total banks that have failed with $1 billion or plus in assets, right? Because if you're a smaller bank, sorry, you weren't operating correctly, you get to be dissolved. It's your problem. You file for bankruptcy, insolvency, whatnot. But of course, once you start hitting $1 billion or more, the government starts to pay attention. Since 1970, there have been 90 banks that have failed with over $1 billion in assets. Wow. That's about 1.7 per year. And then again, once you start getting to these bigger ones, Silicon Valley had 45 billion or something like that in assets. And of course,
yeah, it was huge. And well, I mean, just $42 billion in deposits that were run on the bank in one day.
Okay, sure. Okay, sorry, thank you. Yeah, my number was off. Either way, it's a big enough number that it caught the eye, of course, of the federal government here, and they had to come in and do something to calm the nerves of the general public. Again, for reference, okay, we talked about that 562 bank failures in just the last 22 years. We talked about 90 in the States, over $1 billion in assets in the last 53 years. How many banks have failed in Canada? Zero. Not one. Donut. What does that tell you about the way that Canada essentially runs its banks? And I'm not saying they're better, but they're better to the sense that they're not failing to this degree.
Pretty
incredible.
I mean, there's a whole another layer of transparency in the banking system in Canada, and I think that has a lot to do with it. But just getting back to this sort of age of responsibility here, like, do not give, don't give your money to the bank and think it's safe there. It's not. You have to take control of your hard-earned income and the things you want in your life. No one else is going to do it for them. In fact, if you give your money to someone else, I'd be very, trepidatious in terms of what they're going to do with it. So, as we've said, looking into investments that are going to bring you some form of return. Remember, the first rule of investment is do not lose your investment.
Very fair. Well, let's bring it back closer to home here too. So let's talk about another bailout. TransLink just got a nice $500 million check, $479 million. And that is essentially a BC government bailout to cover their losses and that they haven't recovered since the pandemic, as ridership is understandably very low during that time. And as of now, I think it's only back up to about 80% because a lot of people are now working from home and don't need that same transit. The quote is that the funding will keep fares stable and save transit users from service costs that would be increasing as well there. Again, just, hey, here's the government. We're having troubles. You look to them because, again, our transit can't fail either. And you can't, I don't know what it was going to be, double, triple, whatever the fees. That's not sustainable either. So they had to come in and do this. And it's just like, well, yeah, nobody saw COVID coming, but a lot of companies had to readjust to maintain profitability and sustainability. Other companies just look for the handout. And again, I don't know TransLink's inner workings. Maybe it was completely unavoidable. And I'm not taking sides here either. It's just pointing out that we keep just looking to the government to print more cash, pump it into the companies that aren't figuring it out, aren't working, and saying, okay, great, well, that's all it takes, and we'll just kick the can down for the next generation. This is why we have so many provinces and countries that operate at increasing deficits and increasing debt burdens every single year over year. And it's the only thing that seems to be saving them is population growth in a sense. And then you see the countries that have shrinking populations and they have problems, a la Japan, for example.
Or higher taxes. Right? Because the only way you pay for more of this is by taxing the people more and more and more as well. So, and then the government continues to get bigger and bigger and bigger. I mean, we just went through this with our property taxes, right? I mean, if they keep going at the rate they're going, property taxes in the next 7 years will be up 80%, right? It's how they're planning to pay for everything. And I've said it before, and I'll continue to say it. Well, when do we look at the actual items in the budget that we don't need anymore, the things that maybe should fail? Not everything needs to live. Not everything should survive. That's part of the evolution. So, I want to say that we bail out too many banks, but then hearing that there were 562 bank failures in 22 years, I'd be interested to know how many of those banks actually received bailouts. Exactly, because I'm willing to bet that it's a significant number. And there's consequence to people's actions and decisions and the environment. And so, if you don't survive, it should create innovation for new opportunity and so that we don't, create these messes again and just pump more cash into the system, further, creating more problems for inflation and everybody else who's trying to manage it and doing their part. Right. So anyways, it's easy to point fingers. It's a lot harder to solve the problems. But with that being said, the big banks now are also here back in Canada with we look at homeowners, for example, here. Amortizations by big banks now are actually pushing 40 years. And this is kind of the bank's way of bailing out its own customers so that they don't have to repossess your home. What I think I'm all of this is kind of pointing at is that the government or banks typically always try to protect housing. This is without a doubt. They don't want to sell your home. They don't want to repossess it. Believe you me, we've gone through that process with the banks as listing agents, and it's not a process that they enjoy doing or want to do. But ultimately, what is pushing 40-year amortization schedules mean? And if the bank, doesn't want to deal with it, and all this effectively does is push the problem further down the road for someone else to deal with. And that's likely where we're headed here, right? Dan, why don't you get into the proportion of mortgages here with amortization periods longer than 30 years? Because it's pretty interesting numbers.
Yeah, this is, again, essentially a bailout for homeowners in a sense. Ryan's absolutely right. The banks do not want to take on these homes and then go through the process of selling them. That's not what they want. It is much easier for them to say, okay, well, your payment's not going to change, but the fact that you are not even covering the total interest on your monthly payment now means we are extending the length of the time that you owe us money. We've heard upwards of 50 years now at this point. And this was the first thing I had mentioned 5 months ago that the banks can do to help homeowners keep their homes, keep the money coming into the bank, keep the roof over the head of the homeowners, and again, kick the can down the road for maybe a future payment shock when it comes time to refinance or renew. But it's happening at maybe a bigger degree than a lot of people would expect, because when we look to the big banks, BMO, CIBC, TD, RBC, they're averaging about 30% of their mortgage book are now having amortizations longer than 30 years. That's almost 1 in 3, and that percentage will likely increase over the coming months here. So imagine having 1/3 of your book of mortgages basically paying you zero principal and all interest. I mean, the bank's okay with it temporarily, homeowners not, but again, it keeps the roof over their head. It's a big number. And let's also look back to the early onset of COVID. The first thing that came out or that changed within housing was that all the banks, the federal government said, you can defer your mortgage payment for up to 6 months. And that includes for rental properties as well. The first thing they did was protect housing. So we see this time and time again. Government, as soon as housing is threatened or big banks are threatened, they will write a blank check every single time. Now, deferring payments isn't really a blank check. I get that. But again, they are protecting housing in any way they can. Those are the things that run our country and our world in a sense, right? People need to know their money is safe and they've got a home to go to. If either of those disappear, that's when you see revolutions happen, essentially. So people need to be calmed, their nerves need to be at ease, and that happens through stable housing and stable banking. And governments will do anything, right or wrong. Again, I'm not taking sides here. I'm just kind of sharing my opinion here. Governments will do whatever it takes to protect those things first. And we're seeing it again. And when those refis come up, sure, in the next 1, 2, 3, 4 years, maybe there'll be some shocks then, but who's saying the banks can't rewrite the rules again? 50-year AMs. What else have we talked about? What other levers can they do? Maybe they can pull from other assets. Who knows? They're going to find something to do here, I think, because at the end of the day, they don't want your house for sale. They want you to stay in it. When I say for sale, they mean by them selling it.
Let's be honest, too. I mean, by getting a 40-year AM or a 50-year AM, they're going to make a lot more money, and you're never going to own it. That's the other side of it. And now you can make payments so you can avoid that duration. You can pay down your principal reduction to a certain amount. Most banks have an option like that, but generally speaking, in today's environment, most people would be able to afford to do that. So this sort of leads to, just like we said earlier, kicking the can way further down the road and dealing with it much later on when it rears its ugly head again. This is such human nature to do this. But anyhow, let's move on a little bit here, Dan, to a bit of a housing update here for folks. So I'll take a crack at the national one. So Canadian home prices are down $130,000 on average since the peak. The Canadian housing market has recorded the fewest number of listings for the month of February since 2003. That's a 20-year national low. National home sales hit their lowest levels for the month of February, the lowest since 2009, guys. This is very slow. National home prices fell 15.8% year over year. This is the steepest decline we've seen in national home prices on record.
So national, we talk about this. It's a great reference, but again, it's so hard to peg what a national house is or a national property, for example. What's a downtown Vancouver condo compared to a Saskatchewan detached? So again, while it's very interesting data, we always like to break down what's happening hyper locally here as well. So because things are moving so fast, let's look at where we are. We're halfway through the month. It's March 16th today as we're recording this. And in GVRD here, we've got about 4,300 new listings coming this month. We're halfway there now. For reference, last March was 6,700 new listings hit the market. Wow. So we've been talking about this low inventory and low new listings environment for months and months, and it's happening nationally. I mean, we're 35% new listings coming to market this March compared to last March. And what does that leave us? Well, inventory-wise, we're sitting at about 8,600 units today. That's an 8% increase in the last 2 weeks here. Not a big number compared to where historical averages go. And then when it comes to sales, we're going to end up somewhere right around 2,400 homes are going to transact in the month of March here. Last March was 4,400. So significantly lower, 40% lower-ish. And then what's important? So prices. It seems like everything we're talking about should be pushing prices down. And yes, they're down a lot off the peak, as we mentioned. But February, last month, we saw the HPI tick up for the first time in 9 months. And why we are tracking this so closely is because, hey, was that a fluke? Okay, is it a very unusual thing to see prices go up in the environment that we're talking about, with everything else that's going on here, with the landscape that is in front of us? Well, so far in the first 2 weeks of March, that does not look to be a fluke. We have the average prices up another $80,000 in the first 2 weeks here, and median prices are up $38,000 in just the last 2 weeks. For reference, and this is super important to notice, right now, the median price of a home in Vancouver is only 3.5% off of the all-time high. Peaked in March, April at $1 million, and we're sitting at like 965 right now. So what does this mean? Yeah, what's that, right?
Well, I was just going to say, I mean, you look at what's happening in our environment right now, and you scratch your head, like, how is this happening, right? But again, we've harped on it for so long that we have the biggest inventory issue here that exists, and it's been a problem for decades, and it's going to be a problem for decades. Anyhow, I cut you off.
No, that's fine. It's important to talk about. And so the way things are going with the median average, that means HPI is likely going to trend up as well. So we're going to look at our second monthly HPI increase in a row here. If that were to continue in April, which we don't know yet, anything can still happen. It's almost too early to call the bottom, even though we're looking at 2 months of increases here. But if that continues in April, then it's 3 months in a row. Then we feel pretty comfortable calling it a trend. And then we will recognize that the peak to trough pricing for the HPI will have dropped a total of 13.8%. You can go back to any of our stories in the last 8 months, and you can say that we always called about a 15% maximum drop in price. It's a guess like anything, but it's a guess based on a lot of the data and, of course, what's happened in history here in Vancouver. So as of today, it looks like we are going to see that trend happen again. And Vancouver properties are so resilient that as soon as they hit that 15% range, they're on sale. The banks find a way to stimulate. Things start to go upwards again.
Yeah.
Sales to active listings ratio last month entered the seller's market for the first time in, I believe, 9 months. We were 23%. Anything over 20 is a seller's market. It's trending to be higher. Somewhere around 25, 26% is where the SA, sales to active listings ratio, may end up when things wash out at the end of March here. Quick reference for what's happening in Toronto. During the second week of March, so last week, 44% of homes that sold over the asking price. 44%.
Goodness.
Yeah,
that's almost half of all homes.
And of course, things typically only sell over asking price if there is more than one bid on it, if it's in a competing multiple offer scenario. For reference, in Vancouver, not quite there yet, but month to date for March, we're sitting at 21% of homes are selling over the asking price, with a high likelihood of those all being within at least a 2-offer competing scenario.
Yeah. I mean, we're seeing multiple offers all over the place again. We're in one right now. We're in a multiple offer situation in a backup multiple offer situation, right? Like, this home already has an accepted offer and people are competing for who gets to have a shot at it in the event it doesn't sell.
Perfect anecdotal example here. And I mean, even just looking at properties for my client list of buyers here this week, I found 6 properties, condos mostly, some duplexes and 1 detached, that were holding offers, thinking that they were priced so sharply or that the market's so hot that they expected multiple offers to come in and for this thing to sell over ask. So holding offers, multiple offers are quote unquote back. They're not back with a vengeance, but they're back to the tune of 1 in 5 right now, which is a pretty big number if you think about it.
Yeah, I think if the property is really like half decent, generally speaking, I think that's really a big part of that. A lot of the recent inventory that we've seen hasn't been of the super highest quality, and typically in the spring and in the fall we see higher quality listings hit the marketplace, and those higher quality listings are getting lots of attention. So that's a result of really just not enough listings and buyer demand still existing even in prevailing rates. People still need homes, guys. They still want to grow their families. They still want to live their lives, right? They still want their kids going to a certain school in a different neighborhood. People are still working. So the bottom's it's not crashing. I don't see that happening. There's too much momentum currently in the marketplace. And I think as we're seeing now with bond rates doing what they're doing, ideally this makes people, it makes their mortgages a little bit more affordable with a couple cuts coming. We'll see, right?
As I love to say, don't bet against the house. Love it or hate the rules, government will protect housing in Canada, and the government will protect assets in the States, protect banks. And I'm sure that should a Canadian bank actually fail, chances are I'd put my money on the government bailing them out as well. Mm-hmm. So they're covered, at least in the short term. Again, love or hate that policy, it is the reality we live in. And unfortunately, it's likely the next generation that'll have to deal with it, or maybe the next one again, because they're going to continue to find ways to kick it down the road. Either way, that's where we sit today. Thanks as always for tuning into this episode. And if you liked it, subscribe, and even better, share with a friend. And always feel free to reach out. We'd love to talk real estate with you. Thanks.